Most traders think gold becomes dangerous when the market is chaotic, but in reality, the biggest move in gold often when the market feels completely safe, when volatility drops, when price moves slowly, when nothing seems to be happening. That is usually when the next violent move is already being prepared. Because quiet markets don't mean nothing is happening. They mean liquidity is building. Hello trader, welcome back to Nova channel and let's continue another new topic today. In scalping, many traders become nervous when price starts moving fast. Large candles, sharp momentum, sudden volatility, this often feels risky and unpredictable. But what most traders fail to understand is that the real danger rarely begins during the move. It begins long before it. The most explosive movements in gold usually start during periods of calm. When the market becomes quiet, traders begin to relax. Price moves inside a narrow range, candles ring and volatility fades. After watching the same levels hold again and again, traders slowly build confidence in the structure. Support looks reliable. Resistance seems predictable. The chart appears clean and easy to read. This is when positioning begins to concentrate. Scalpers start buying near the same support levels and selling near the same resistance. Stop losses begin stacking just outside the range. Liquidity slowly accumulates above highs and below lows. And the more times price respect the boundaries, the more traders trust those levels. But financial markets do not reward consensus. When too many traders feel safe in the same area, the market suddenly has exactly what it needs: liquidity. And once enough liquidity is built, the quiet market can transform into a violent expansion within seconds. Gold is particularly famous for this behavior. Price may spend hours moving sideways in a tight box, barely moving $20 or $30. Traders begin to believe that the range will continue indefinitely. Some start increasing position size because the environment feels stable. Others place breakout orders just outside the range, expecting a clean move when the market finally decides on the direction. Then suddenly the range breaks, price buys aggressively, sweeping stop losses on one side of the range. Momentum accelerates as trap traders rush to exit, breakout traders pour in late. Liquidity vanishes, volatility exploded, and the slow market transformed into a rapid expansion. The move that followed often becomes the largest move of the session. Ironically, the traders who fear the most comfortable movements before the breakout are usually the ones caught on the wrong side of the move, not because the analysis was terrible, but because they trusted the calm environment too much. Professional scalpers understand something different. They do not relax when the market becomes quiet. In fact, they become more alert. Tight range is not a safe haven a tight ring is not a safe environment. This is compression phase, just like a string being pressed tighter and tighter. The longer price stays confined, the more powerful the release can become. This is why experienced scalpers pay close attention how liquidity forms during slow periods. Instead of assuming the range will hold forever, they watch for the movement. When the market begins targeting the cluster of stop loss built around the range. Because in gold trading, the largest moves rarely begin during chaos. They begin during comfort. The candles become small, the chart becomes quiet, traders begin to trust the structure. And thus is precisely when the market prepares to move the most. So, next time gold look calm and predictable, remember this. The market doesn't become dangerous when traders are afraid. It becomes dangerous when traders feel safe. And that is the topic today. Thank you so much for your watching. And don't forget to like and subscribe to our channel to receive more useful video for your trading journey. Happy trading and see you in the next video.